Is the market wrong about software stocks? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Jeremy Schwartz, the Global Chief Investment Officer at WisdomTree. Hi, Jeremy. It's great to see you again.
Maggie, thanks for having me on. Pleasure to be here.
Yeah, so much to discuss. So we saw some. So we have stock markets that are kind of rotating, churning. I don't know what we want to call it, and we're trying to figure out which. Maybe we have a big jobs report in the news. We have some sectors really getting beat up. We have Japan. We have gold. So we're going to cover all of that. But let's start with the stock market because we saw some early gains off the back of a much better than expected monthly jobs number from January. It was a bit delayed because of the quick shutdown, but that faded as we worked through the session. And a lot of it, we seem to be weighing these AI concerns versus earnings and maybe what looks like a pretty good US economy. So how are you balancing out those two things?
Well, there's so much narrative and noise out there on AI. I mean, that is like the dominating, and even with the jobs market, is like, there's so much out there about what is AI going to do and disrupt. We're talking about software is like the prime stocks that we're getting crushed again today. And it's sort of this fear of, will AI take over? We're no longer going to need software because you're going to write your own software. The engineers are out. We're at the beginning of a job shakeup, and the speed of technology is increasing so fast. So there is this overhang of fear, just uncertainties. You don't know really how it's going to develop, but the developments recently have been so strong that it scares some people. I mean, the jobs report today, if you would have gone 12 months ago, you'd say, oh, it was kind of a meh. We were expecting 200,000, 250,000, and it was a great number for today, but like in the scheme of things in the past, it wouldn't have been that great. Now the normal jobs prints today with less immigration is like 0 to 50. So you get a number like today, and it's actually pretty good. Now you have all this noise about the benchmark revisions, and we had a lot less jobs last year. The markets tend to are forward looking. They're thinking about like, what is the case this year? We're going to avoid a recession, and where are things going. We do think it could be a year where we don't have that much jobs growth, but the economy still does well because of this productivity story that we are doing a lot more with less. That you're able to actually grow output, grow margins as a business, and just not hire as many people. So this sort of no hire, no fire type discussion that you hear a lot. We think there's a lot to that. I mean, I think a lot of companies are trying to say we're not going to hire. Big companies, Walmart, biggest employer around, say we're not trying to hire Jamie Dimon so we could have less people 5 years from now. So you hear these big behemoths of companies trying to say we're going to use the technology to do more. And so that is the overhang for the economy, but also it doesn't make you bearish the markets. Like if anything, that makes me, people worry that the market's expensive and margins are at quote unquote cyclical highs, all-time highs. Will they mean revert? But what if they just keep accelerating? What if margins actually, because of this new technology, are not mean revert? Are not mean revert. Actually, they might keep accelerating higher. And I think that's more my view, and particularly outside of large caps, which have been the prime beneficiaries of all this tech. The broadening out story, I think, is margins doing better as the Fed keeps cutting rates and we start to learn how to use this technology. Everybody.
Yeah. So you brought up a couple of really important points there. And I think there's no easy answer, right? Because it sounds like it's going to be really good for some things and not so good for others. So if you're talking about economic growth and no hire, no fire, and companies figuring out how to use this, is that by definition better for stocks with lower valuations, like it hasn't been priced in yet? Is it better for small cap stocks who could really benefit, who really have to run those expenses, can benefit from that sort of labor save?
Yeah, I mean, there's some studies saying, if you save 1% labor in large caps, what is the EPS impact for large versus small? And there is definitely more gearing to labor savings in small caps. So there's no question that is true. But there's also just so much volatility in the markets. Like even a big financial services company like Schwab is sort of like a prime custodian. They make their money from really people keeping money there, and they earn your interest off the spread. I call it dumb cash. You keep your money, you don't get any interest. they were down like 9-10% yesterday because a newer startup altruist talked about an AI tax savings app and like AI, ooh, and that
Well,
they
because now it's the AI killer, like the sector
right,
killer, right? That's what we're talking about in that benefit. And there's a huge argument going on. And by the way, you and I talked right before we came on air. I'm sure many of you in the chat, hi, everybody watching on Substack and YouTube Live. By the way, put your questions in and we'll get to as many as we can. But I feel like between the Matt Schumer post that went viral, and then I don't know if a lot of you saw on X, there was somebody who was claiming that they were the human in behind the whole Moltbach Claude, AI agents are taking over the world, creating their social media. Supposedly, there are all these humans who claimed responsibility, and then people thought they were AI agents just saying it on X. I mean, it's getting very sci-fi, but there is still this really robust conversation about how much is real in terms of gains and how much isn't. And we don't
right.
really know yet, right?
So yeah, that Schumer post I this morning I'd seen that went to 15 million people on X, and I shared it with my team, and because we're doing all sorts of AI workflow reviews, and I was using it to say make sure people had seen it. I'm plugged into the social posts here. But I quoted the paragraph I put in my email was, like, this is the most important year of your career, and you want to be the person to show up to the room with, here's how AI, something that could have taken 3 days, but I figured it out and did it in, a few hours. I see real examples from this. I was giving an example, that our team was together yesterday, a bunch of us in New York, and there's an lasting project that I've wanted done for, call it, a few years, and just people are busy and you don't get to it, and you go to one party to the next, but it's always on my mind as something that I want for all of our rebalances. And using Codex, our team has built basically an app where we can sandbox, where we can develop new apps, and using Codex to help write sort of basically Python code, and just some quick prompting of this thing, describing what we're looking to do, uploading some documents that have been a component to what we're doing. 30 minutes later, it's a beautiful looking app that gets me 80% of what I'm looking for. And then they refine it. And, this team could have done the code, but all they did is prompt Codex to do it. And Codex did an amazing job. So, there is, you can see, now that's a huge productivity enhancer. And so there's part of the narrative out there is that you want less people, that the entry level jobs are going to be replaced. And I don't know if how much is me versus other people think. I would say it's the reverse. I actually want as many of these young people, because they are going to use the tools more innately than the more mature people are stuck in their ways. You're sort of, if you grew up with it, and listen, we're all just learning this stuff now, but you've got it. There is something to not having set ways and being, it actually is a great equalizer in terms of bringing talent up quickly if you use the tool. So I do believe in that it's a leveling of the playing field. Anybody can become a super coder with this kind of system. And in some ways it can make people more productive, and then you want more of them. You may not want, in certain places, I could see you wanting to hire more, not less.
Yeah, I think that's the dream, right?
Yeah.
Yeah. You just described what the hope is for everyone out there when it comes to AI. What do you think about software stocks? Tommy Thornton, hey Tommy, is in the chat, and he said software is in the buy zone just because it's been beat up so much. Or does it feel like we're at this really critical moment where you're like, okay, maybe some software companies will rebound, but maybe some won't. Maybe this is the moment where you have to really existentially think about who's going to make it.
We have an ETF that's probably like the prime of the hit zone. So WCLD, cloud computing, these have been, the big run-ups in the 2020 pandemic, and they are, it was down 3.5% today, showing, like that it is, and it's sort of getting back towards the low points where it hit in April of last year before the big run-ups. They are the center point of a lot of these areas. There are a bunch of these software stocks that I completely agree with Tommy that it is way beyond they've become they went from being the most expensive stocks in the market to many of them being value stocks. Like we have one index that I was looking at in Europe the other day that is a value index focusing on high stock buybacks. And usually you think value, you think banks, energy, cyclicals. The top 10 was almost all software. It was Zoom, Adobe, and Zoom has like some of the Anthropic shares on their balance sheet. Adobe is the cheapest it's been in maybe ever, and they're buying, and management thinks they're buying back stocks. And Adobe is one where you say, oh, Notebook LLM, these chats, you can create great, beautiful images in Notebook LLM. You get all these infographics. You're not going to use Adobe anymore, right? So that's the narrative out there. That is, it's like this prime disruption from Adobe. But you think they're not doing AI at all at Adobe? Like,
yeah, I know.
They're not going to find use cases to make their systems better, and they're not going to be able to figure out how they do a little bit with less people. They're not going to change their pricing models. Like I do think there gets to be a narrative, and that narrative was true for Alphabet last year. Everybody thought Google was going to be disrupted and search was going away, and we were no longer going to, and hey, Google's business is you pay for clicks on their search business, and that's like their big cash cow. Now ChatGPT is going to make we're not going to use Google. Well, now it's like the prime AI stock. So narratives change, and I do think many of these software stocks, the narrative is that they're being displaced, and some of them will not, and some of the infrastructure on them will stick around. I think Salesforce is another example. Like Salesforce is one that's been hit pretty hard. And if you're a big, and I don't think we're a big company, we're a 300-person company. We use Salesforce for a lot of our CRM. Like, are we going to really spend our engineers' time to go reinvent Salesforce, or are we just going to build apps on top of what we have? It's much more likely we are not going to go reinvent Salesforce. Like, we have much better uses of the time. Like, we are going to find we are going to just build on top of it, which we are, and so,
it takes you half an hour now that you have Codex and a creative young thinker. Every time I have these conversations, I always think like the power of creative thinking right now, if you are not locked into what was in the past, whether you're young or old, if you are able to. But I think someone just made a point that it is true, everything you said. And this is where we get back to the jobs market. I'm wondering, I want to sort of make a thread to where we're going with the Fed, because I think they're in a tough spot because of this intersection that we're sitting at. Adobe has more than 30,000 employees. So, it may reinvent itself, but what happens to all those jobs? And so there's so much fear about AI taking jobs. I think that's when we saw that monthly jobs number today. Everyone was like, oh, wait a minute. But a lot of it was in healthcare, if I'm not mistaken, right? And some of those areas. So when it comes to the Fed, what are they watching? Is it the jobs market? If we start to see AI bite into jobs, is that what the focus is going to be, especially if it's a Warsh Fed? Are they looking at or more worried about growth and inflation? Like, how do you think that they're talking about this challenge?
Well, we do. There's a lot of noise on Warsh also. We actually, our senior economist at WisdomTree, Jeremy Siegel, has strongly endorsed Warsh. He thinks Warsh was the top pick, actually, of all the picks. There's some noise about what his misinterpretation of QE during the financial crisis that would create inflation. There's a lot that he got wrong on that. A lot of people got wrong on it. But you can look past that, and actually his goal of, and again, reducing the balance sheet is one that people fear about. Oh, we're going to have this declining asset prices if we reduce the balance sheet, which actually we like the goal of reducing the balance sheet. And it's not something that happens overnight. It's not like he comes in, everybody's going to say, yes, got to dramatically reduce the balance sheet.
Like a hatchet to it. Right?
But there is something to what he's saying. And the Fed, part where the Fed went wrong, we think over the last few years, is they used to have a daily signal where they too tight or too loose because there's a well-functioning Fed funds market. And every day, this is pre-QE, which is, again, what he kind of wants to go away from is pre-QE, you had this scarce reserve regime. Every day, the Fed would have to transact in the Fed funds market, and that'd be a signal where they too tight or too loose. Now they've got this cabal of central bankers who say, yeah, we know what the right rate is. They sort of lost the daily signal from pre-QE. And so reducing the balance sheet would be a step towards doing that. Now, we do think they should be lowering rates more. We think inflation is a bit lower. There's some stale stuff in the CPI from rent, and real-time rents are much, much lower than what's in the CPI. but they're not far really from where we think they should be. They're maybe 2 to 3 cuts from where they should be. And so they've corrected some being too tight for too long, but productivity, this AI stuff is deflationary, actually. Like there's elements of, all right, we need to spend more on copper to build a data center, and we need more energy. There's elements of components of it that are inflationary, but the big trend for the economy, macro-wise, is deflationary. And so but that's a thing that takes time to work out. But productivity growth, if it's as real as we see, then that is an offset to the inflation pressures.
Yeah, I think that I had a conversation with Luke Groman recently, and I asked him about that. If we have some goods inflation because of, reshoring or a multipolar world, or, spending for national security on that type of stuff, is that offset by the deflationary trend of technology? And he's like, yeah, maybe, but when you're losing jobs, you're gutting your tax base. And so it's like, does that create a problem that, and so if you circle that back around, well, it may all work out, but you may not be able to get bond rates down because of that, right? Like they'll maybe get them down on the front end, but, do you have this problem where you have no revenue now coming in, and so your problems with your debt, and it's going to show up in the bond market? Do you worry about the longer end of the bond market?
Well, I think when you look at things, and Luke focuses a lot on gold, we've been talking about gold. I mean, when you look at the movement in gold, it's worried about something. I mean, it's, being up as much as it is in the last 12, 18 months, you talk about the COVID response, and at first it did do well during COVID. And then you had this surging money supply, which was one of our signposts of inflation. Another thing the Fed really misses, 40% move in money supply, that's going to feed into inflation. But you're like, well, Bitcoin was taking all the energy in the room from this sort of inflationary hedge, and gold was kind of underperforming. Like, hey, we've had all this inflation, where's gold? And well, Bitcoin was surging at the time. And now you've got Bitcoin really falling and gold coming back in a meaningful way. And so I do think some of that is, how are we managing all these debt and deficits? A lot of it is geopolitics, and it's China saying, maybe I need to hold less treasuries, but also other central banks saying, seeing what happened with the U.S. and Russia and their holdings, and just saying we need to diversify out of treasuries and dollars a little bit. I do think you hear people like Elon saying our only solution is robots and AI dramatically increasing our GDP, and there's no way out of our fiscal mess without that. Like that, you need dramatic expansion of GDP. The way you've gotten out of debt is inflation. That's really the truth. And so that even to like the situation Japan's in, where they had the highest debt to GDP, and deflation was the problem. But if you have inflation, your nominal GDP is growing, but your fixed debt is still outstanding, and that's sort of one way it becomes more manageable. But
so maybe higher inflation moving ahead.
That's one thing that high debt levels imply. But productivity is the other answer. Like the robots, the AI, all these things that could expand our output is the holy grail.
Yeah. And I guess the question is, can you get them balanced enough where maybe you get inflation, but you get enough productivity? I mean, it's like not a soft landing. It's kind of the reverse of that. But that is, it's a kind of, it makes me think of some kind of Star Wars movie where they're trying to get in a canyon. It's like it can happen. You can get there, but it's a really tight space. You got to hit it exactly right. You mentioned gold, and I'm curious about that. So, I mean, you guys have all sorts of ETFs and financial products. What are you hearing in terms of incoming for people when it comes to their exposure to gold? Because traditionally, U.S. investors underexposed to commodities and gold. What are you hearing? What are you seeing? And how are you guys approaching that?
Well, I just came back from a 10-day trip to Europe. It's interesting contrasting US and Europe. In Europe, like if I look at the ETF markets, 3.5 trillion of ETFs in Europe, we have like 13.8 trillion in the US. So we're 4 times plus bigger of a market here in the US. In Europe, they have about 250 billion in commodity funds. So almost 8% of all ETF assets are in commodities. In the US, we have an ETF market 4 times as big, but less in commodities. So our average allocation is like 1.5%. Like people have been say, oh, well, in Europe they have no equity culture. They don't invest in equities, even though bonds yield nothing and stocks are actually pretty, relatively reasonably priced. They don't have an equity culture. So, and they've had a lot of problems with currencies over time. So it makes sense why they'd have a lot more gold. But you say, what is the right allocation to gold? And, if we're at 1.5% in commodities, and it's predominantly gold. It's not some diversified commodity basket. It's mostly gold, a little bit of silver. Some of our studies have said a more optimal portfolio is like 10 to 20% in gold and commodities. Yes, big numbers. And if you just took a passive allocation, by the way, if you just said, I'm going to take a passive allocation to the liquid market, stocks, bonds, gold, what would the passive allocation be? It'd be 52% equities, 32 bonds, and 12 gold. 12 is just the size of the market. Now, again, the typical is 2, less than 2. And so people are very far from that. One of the things we did, today, we're in Europe, we have about 60 billion, 40 billion in commodities, metals. We're very much focused on that. In the US, we got started later, but we have a very interesting idea. GDE is essentially US core stocks plus gold futures on top. And then for those real bulls on gold, we have miners plus gold on top. So GDMN is the miners one with gold futures, and then GDE is the stocks with gold futures. And the idea was, for stocks is, and I helped Professor Siegel write the book Stocks for the Long Run. So we believe in stocks. It's like, well,
people are probably like, what? Wait.
I don't want to sell my stocks to add gold. Like, right, stocks did 6% real, 6 to 7% real after inflation. They really are a good inflation hedge, maybe the best inflation hedge. But gold, there's times when it's a very nice diversifier, times of geopolitical conflict. It does keep up with inflation over very long periods. Actually, since 1970, it's beaten bonds. It's done 4 to 5% in real terms last 50 years, second to stocks of the major asset classes. And so you could say, well, if I just want to add gold but not give up my stocks, GDE is the right answer. We've seen a lot of traction in that the last 3-4 years. And
interesting. So the idea is it's sort of like sort of a barbell approach within your own, like you're kind of getting both without having to make a decision to sell, because I think that's what many of us are facing. If you were in a traditional, especially in a traditional 401, or really, an active investor, self-directed, you have this overexposure to equities and you've done well with it. And then for people to, I think a lot of people are wondering, is gold sustainable? Do I take money out, maybe take a tax hit? Well, all the other reasons that make people reluctant to sell down their equity position in order to up something else. Now, there was an argument, take it out of bonds, move it all out of bonds, right? So now you're just stocks and gold. Right. But you're sort of saying you don't have to make a binary decision.
Yeah, there's people saying the new 60-40 is in stocks and bonds, it's stocks and commodities. There's like some studies from one of the big banks in that. And so the official allocation in GDE is for every dollar we put 90 cents in stocks, 90 cents in gold futures. There's 10 cents of collateral for managing the collateral with the futures. But so it's effectively $1.90 of exposure, where you have 10 cents in cash and 90 each in stocks and gold. And so that is a thing that you could keep your stock. Like if you just substituted a traditional core equity with that, you could keep all your bonds and now add your gold right on top. And
interesting. Because I feel like people were so emphatic about 60-40 being dead, but I've been talking to people lately about bonds too. And, like it's never that simple. And we're in this weird transition period where I think it's very hard to see into the future. So I could see the appeal of, maybe not having to sort of go all in or not. Talk to me a little bit about international, because that's the other diversification. And every time you come in, I always ask you, especially about Japan, because I know you personally been watching it for a long time, but I feel like WisdomTree has international ETFs as well. And I'm just wondering, it's kind of the same question. We tend to be overweight US because it's where we've been, what we know. And the volatility in, say, emerging markets was very high. And if you've been around for a while, you know that. And so it's sort of own what you know. What are you seeing and hearing in terms of people's desire to diversify internationally? And where do you see sort of momentum in traffic?
We had the election this weekend with Takaichi, a blowout election, and she was way more seats than people expected. She's definitely very, it was interesting. Like it's a very, they're going to, the big part of her thesis is rearm Japan, be a strong ally of the US in Asia. She wants to close their borders and try to retain their Japanese culture to some extent, but it's really about rearming Japan. And so there's going to be a lot of money in defense. You saw Korean defense stocks up. We have an Asian defense idea. Last year, we had a blockbuster in Europe. It was the first European-focused defense ETF in Europe. We raised about $5 billion in 10 months. I think Asia defense is equally an important theme, and it's been running for sure the last 12 months.
I was going to say, has it already been priced in?
It's starting, yeah. I mean, but it's actually still, this is not a one-year trade. These things are going to be with us. Like Japan is just starting, I think. So yes, it's moved in 12 months, but I think it's still, I'd rather Asian defense even over Europe defense today. But I think Japan, people think, so money is moving back to emerging markets. It was a very hot January. You saw emerging markets double the US returns last 12 months. I'm a little bit more hawkish on China. I'd be more cautious than the market is. The market is moving into China. I would much rather Japan. In Japan and India, if you wanted to barbell growth and value. But it's when you look at, I've been talking a lot about a newer fund. People know DXJ. It was a flagship fund for us. It's still a $6 billion fund. It's leading our inflows this year. It's probably taking about $500 million in January. So money's coming back a little bit on Takaichi. OPPJ was our play with Buffett buying all the Japan stocks. I'm sure I've talked with you before. Hey, follow Buffett into Japan. And one of the feedback points people be like, give me more exposure to those Buffett stocks. They're meaningful, and he would like to increase his weight. So OPPJ has almost half the weight in those 5 Buffett stocks. And then we're like looking for the next stocks Buffett would buy. And
so are you worried about a repatriation trade that you see all that Japanese money come home because of changes that the PM is going to put into effect, and that hurts U.S. assets?
I think their bond yields have been moving up. So the last 12 months, the 10-year went from 120 to 220. While our 10-year went down, called 460 to 420. So there was like 140, 150 basis point widening gap of their 10-year becoming more attractive relative to the US. There's no question that is true. Now, so that you could say maybe they sell some treasuries to buy some of their Japanese bonds because they're now a little bit more attractive. The cost to hedge is still, for them to hedge the dollar on the short-term basis is like 3%. Their Bank of Japan rate's like 75. We're still in the upper threes. So it's still, to hedge, it's almost 3% cost. I think there could be some movement back, but overall, I'm not overly concerned with that. I think the bigger impulse is they now have inflation as a new mindset. They were stuck in deflation, so it made sense for all their consumers to keep money in cash. Things would just get cheaper over time. An inflationary mindset, you need growth, and they now see. I don't know if people remember, the Dow and the Nikkei were set at similar levels. So like when you compare the Dow just crossing 50,000 for the first time, they're at now 58,000. So now that Japan is now outperforming the Dow, the Nikkei is higher, and it's been a strong market. S&P kind of flattish this year. Some of our Japan funds up 15 year to date, but it's still cheap. I mean, I'm talking 14 PEs, 14, 15 PEs, 10 points below the S&P. So our equity premium stocks versus bonds is 2.5. In my OPPJ, it's 7, comparing the valuations versus their bond yields. They should still be buying stocks locally in Japan. We should be buying their stocks. They're cheap. Earnings are growing. They've got AI derivative plays all over. And they're our ally in Asia. So it's certainly been my top market for the last decade. And it still is. I still think it's a great place to be.
Boy, it has certainly been paying off lately. Let's end with Bitcoin quickly. You feel like there's more downside? This has just been pretty painful, but nothing new. If you're in the crypto world, we've seen these drawdowns before. Does this just feel like another cycle, or does it feel like something's different here?
Well, the people are looking for the next catalyst, like who's left to buy is always the question, sort of like, but gold was left for Bitcoin's trails, and now gold is moving and Bitcoin's not. Leverage is coming out of the system. That you didn't see a lot of levered players, a lot of liquidations and wipeouts. We did a little study on recently had one of the 10 largest liquidations ever. 6 months in the future, almost all of them were higher, but in the one, from 1 week to 3 months, it could be dicey. So like, I think you're still working off this recent vol. It could be, dicey for another month or two. And then, I think there is still a community that really does use crypto and Bitcoin more than gold. I think I'm right in the straddling line of the age profile that owns both. Somebody tweeted out a Warsh document saying people below 40 own Bitcoin. I'm like, well, I'm 44 and I own both. So,
that's right. You are the straddle generation in between, for sure. Jeremy, it's always so great to catch up with you. Appreciate your global view, and also just kind of finger on the pulse of what some investors are doing and where the appetite is. So really appreciate it.
Thank you so much. Thanks for having me.
I love it. Have a fantastic weekend. I know you're off on a trip, so safe travels.
Thanks,
and thanks to everybody who joined. I appreciate it. We'll see you on Friday for Dale's residency with all these market moves. I'm sure he's going to have a lot to say. That dollar yen hit his target, so we'll see what he's looking at next. Thanks, everybody. Take care and good luck out there.